Good Monday morning, 30 minutes until the first trading day of December. I'm Matt Miller. Dani Berger is off today. Bloomberg Open Interest starts right now. Coming up, the buzz is building around Kevin Hassett as President Trump says he knows his choice to lead the Fed. And Black Friday shoppers showed up and spent. Retail sales jumped over 4%, signaling surprising consumer resilience, plus a risk-off start to December trading as Bitcoin sinks below 86,000 and traders brace for deeper drops in stocks as well. Stocks to watch today include Eli Lilly cutting costs for the first time. Buyers of its Zepound weight loss drug when paying cash, the latest in a price war with Novo Nordisk. That hasn't helped the shares in the pre-market. Lilly is down. Bitcoin, its drop also sending down shares of companies like MicroStrategy. The crypto sell-off resumes and MicroStrategy down almost 5%. Plus, Nvidia and Mag 7 stocks are lower to start the month. Nvidia says it's invested $2 billion in Synopsys common stock. That's a company that makes software to help design chips. Let's talk about that with Bloomberg Tech co-host Caroline Hyde. She joins us here on set to kick off the week. And Caroline, another deal here from Nvidia investing this time in a chip designing software maker. And
a public one at this. And it's done it before. Remember, invested in Intel, but largely we've seen it go into companies that help fuel the purchase of its GPUs, whether it's a neocloud like CoreWeave, whether it's OpenAI that needs the chips for designing its large language model. But we understand that this is all about the design, the CUDA offering. Remember, Nvidia is so dominant because it's sort of a full stack. You get the hardware, you get the chips, you also get the software with which to be training your large language models. CUDA, CUDA as it's known. This is chip design and software company Synopsys that publicly trades, has not done well on the public markets. And now we see Nvidia coming in and snapping up $2 billion worth. But they say this is a partnership. This is about expanding time to ultimately the offering, but also speed to market. So it's meant to be a win-win on both sides. Thus far, it's a win for Synopsys shares, maybe not so much for Nvidia.
Not so much for Nvidia, although sentiment is obviously down today because in part of the drop in Bitcoin, which is, I was thinking this morning, if someone had told us 10 years ago that moves in Bitcoin could lead the entire market, we wouldn't have believed it. But that looks like what's happening.
It does, and whether or not it's a macro issue, what's happening with Japan, what's happening with ultimately the cost of government debt in Japan and what that means for the carry trade, that's a macro headwind. But there's a lot of specifics that are going on in the crypto world that's got us anxious. Largely, one of the biggest buyers of Bitcoin, MicroStrategy, or Strategy, artist formerly known as MicroStrategy, has actually seen its CEO go on a podcast. Because remember, Michael Saylor is the chair. The CEO is saying, we could sell Bitcoin. What happened to the hodl mentality? So people are worrying that they're going to, basically because of the net asset value, the overall enterprise value of MicroStrategy falling below the actual amount that its Bitcoin is worth, could that force it to sell because it's got to pay off dividends? Then you've got to look at what's happening with Tether, stable coins. It's interesting, S&P give ratings to stablecoin issuers. They are worried about Tether. Tether's fighting back, saying you just don't understand our complexity, and of course it's because we're sort of a new world of financial instrument. But more broadly, they're saying you don't have enough buffers, safe buffers, to be able to pay back a Tether one for one. Remember, they've gone more into the world of Bitcoin ownership and into other corporate loans and the like, not just treasuries, not just cash. That's the key worry. And then you just got China as well worrying a little bit about stablecoins and crypto. Yeah,
so Noor Ali at the MLive blog points out that the Bitcoin fear and greed indicator has fallen faster than the price itself. And hearing these things from people like, what's his name, Fong Li at
CEO
at Strategy. I know they changed their name to Strategy, simply Strategy, which is like so generic that it can't really be the name for a company. But okay. If they sell off, like that just seems like it would snowball into a bigger sell-off in crypto.
And Matt, you're so right. I think the issue here is, who is the buyer? Why are we not seeing people piling back into the ETFs at the moment? They have been a key buyer. Where's the institutional buyer? Where is the dip buyer? I think that's what many people are wondering at this moment. $80,000 is kind of the level everyone's now looking at. Remember, we've been here when we're looking at the $86,000 level, but a few weeks ago. I feel it's sentiment, right? We need a sentiment shift, and many are wondering about how they're booking their losses going into the end of the year.
I remember being at $86 So this is
It's still somewhere in your
long way
on
from,
some hardware that you can access.
from there. Yeah, Caroline Hyde, thanks so much for joining us, reminding me of my lost Bitcoin. Turning our attention now to Big Pharma. Eli Lilly announcing it will cut the prices for introductory doses of Zepound if you pay cash. This is just the latest move in the price war with Novo Nordisk that's getting more and more confusing in terms of pricing for these weight loss drugs. Joining us now to talk about it is someone who understands everything, at least in regards to this industry, Bloomberg Health reporter Madison Muller. So what do we know about Zepound? Now it's what, the 5 milligram doses, the starter doses are going to be even cheaper.
Exactly. So the beginning doses, the starter doses, which, like you said, people sort of stay on for a month, maybe 2 months. This is, because these drugs cause nausea and some GI side effects, people have to step up. So they can't start at the highest dose. They have to start lower and go up. So what Lilly and Novo are doing is offering some discounts on those starting doses. So Lilly's discounting the price of the first starter dose by $50 and shaving even more off of that second starter dose. And they're keeping the same prices for the higher doses. And this is sort of what we're seeing for Novo as well, which is discounting the first 2 months of treatment even further. A couple of weeks ago, they did that. But for patients, once they get to those actual therapeutic doses that you're supposed to stay on, those prices aren't really changing much.
Right, that's the key word, right? Therapeutic doses. That's the dose at which these things are proven in trials medically functioning, and not the starter dose of 5 milligrams, the transitioning dose of 7.5 milligrams for Zepound, for Wegovy and Ozempic. It's different, 0.25 and 0.5. But what they're trying to do, I guess, is get you in, give you a taste of the weight loss, and get you kind of stuck in it before you have to pay full dollar for the therapeutic doses.
Right, and it's really hard for patients because I think even though these discounts are good for patients at the end of the day, there's a lot of confusion. I mean, I'm talking to people who are still paying the $500 for Wegovy and Ozempic when they should be paying a lot less at this point. And so hopefully the price will start to come down across the board and these discounts will be more uniform. I mean, Lilly and Novo both also struck deals with the Trump administration last month to bring down the price of these drugs starting next year. And so hopefully some of these discounts will start to be a little bit more universal. But the hard thing is that insurance coverage is still pretty patchy. And so there are a lot of insurers that don't cover these medications at the moment. And that's why Lilly and Novo are having to discount the drugs the way that they are.
Also, do they want to get rid of some of the stock before someone comes out with a pill that's more popular, or a shot that you only take once every 3 months instead of once a week?
Right. I mean, that's the other thing, is that pills are coming, and that's going to put additional pricing pressure on this whole category. I mean, we're expecting pills probably next year. Lilly and Novo are both working on their own versions, and the starting doses of those are expected to be even lower, around $150 a month. And that's part of the Trump administration deal as well. But that's, another expectation is that those will be really widely available to patients. It'll be interesting, though, because obviously the demand for these shots is really, really high. So whether or not people will switch over to the pills or whether that will open sort of a whole new market of patients sort of remains to be seen.
Madison, thanks so much for joining us on this. Really one of the two big themes of these markets over the last 3 years, AI and these weight loss drugs. Now let's get to, it is, of course, Cyber Monday. So despite all the concern around higher prices, a weaker job market, a falling consumer confidence, Black Friday sales actually rose from a year ago. Sales increased 4% as Americans flexed their spending power. Bloomberg Markets correspondent Nora Melinda joins us now to tell us what drove the gains and what kind of deals were out there.
Well, there were clearly a lot of deals, and everyone's really been looking for a deal in this environment. I mean, Walmart called it the fact that a lot of consumers were actually going for Vizio TVs and Oura Rings, and everyone's really looking for some way to save money, and they're really trying to get out there right now. As they're looking ahead to the holiday season, you're seeing people really just trying to find any way to save money. A lot of the conversation heading into this Black Friday season has been analysts really looking to see how much of the consumer is spending on buy now, pay later, because of course we know that credit card debt is at record high levels right now, especially given the economy that we're dealing with. We've been talking about this K-shaped economy, which of course is the bifurcation of the upper class still being able to spend while the lower income consumer is still struggling during this economic recovery. So it'll be interesting to parse through and see what we get in terms of the metrics from the buy now, pay later spending. But clearly people were coming out and they were willing to spend. The National Retail Federation saying that they expected 187 million consumers for a record year. So we'll have to see. Today's Cyber Monday, of course.
I'll tell you that we just got headlines from Klarna, one of the big buy now, pay later companies, saying that it had I guess, volume up 45% year over year for November 1st through Black Friday, November 28th. So at least in terms of that metric,
right.
And it's relatively new, so that kind of growth isn't surprising, but more and more people are using this stuff. What earnings are we going to get this week? It feels like earnings season is over, but we still get retail earnings coming out, right?
Yes, we still have more retail earnings to come. Of course, what we've been parsing really through right now is what TJ Maxx we got Walmart. There's a few others that are coming, but what we're really looking at right now is a very mixed landscape here. If you just parse through the earnings that we've been seeing thus far, we're really seeing a split. We're seeing Home Depot calling out the fact that they're struggling. People are not spending on big ticket items, but then you've got the likes of TJ Maxx doing well. So we're really looking at the discount names in this environment, seeing performance, really outperformance there from their competitors.
All right, it'll be interesting to see what the dollar stores show us this week. Nora, thanks very much. Nora Melinda covers stocks for us here on Bloomberg Television. Next hour, we're going to talk retail spending with Marc Rosen of Catalyst Brands. That company owns JCPenney as well as Brooks Brothers. Check here on futures as we head into the first cash session of December. You can see that we are down 0.6% on S&P futures. NASDAQ futures down about 0.8%. The small caps moving even lower. I will say typically, well, over the last 30 years, December is a good month, up about 1%, a little less than that. But if you look over the last decade, it's not a good month, off about 0.1%. We were down 2.5%. December last year. Let's get a look at some of the individual stories that we're following this morning. Canadian miner Barrick is climbing as it weighs an IPO of its North American gold assets. You can see the 3.8% gain in the pre-market there. Airbus is dealing with two new problems on its top-selling A320, the most flown jet in the world. The company found quality issues on some fuselage panels that need inspection just days after revealing a software glitch that affects 6,000 aircraft. These are the ADRs in the pre-market. And Moderna is down after William Blair flagged an FDA memo linking COVID vaccines in younger people to deaths associated with myocarditis, something that we already know way too much about from the pandemic. Coming up, President Trump claims he's picked his next Fed chair, but won't spill the name as buzz builds around Kevin Hassett and the promise of sweeping rate cuts. This is Bloomberg Open Interest. Let's get to high interest. Look at what's making headlines around the world. U.S. and Ukrainian negotiators called their Florida meeting, quote, productive. Despite the lack of a breakthrough, U.S. envoy Steve Witkoff now travels to Moscow with a 19-point ceasefire plan. Kiev insists any deal must protect its sovereignty, while President Trump says there's a good chance an agreement can be reached. Goldman Sachs is buying Innovator Capital for $2 billion. The deal instantly expands Goldman's footprint in the booming buffer ETF market. Innovator runs $28 billion in defined outcome funds designed to limit losses. The deal lifts Goldman's ETF assets to about $79 billion, and that deal is expected to close next year. Meanwhile, in Washington, D.C., President Trump says he's chosen his next Federal Reserve chair, but he won't name his pick.
Chair, are you any closer on that right now?
I know who I'm going to pick. Yeah.
Ooh, tell me, Kevin Hassett.
I'm not telling you.
Advisors say Kevin Hassett is the leading contender as Trump pushes for aggressive rate cuts. Hassett calls the rumors premature, but signals he'd support cheaper borrowing costs. An announcement is expected before Christmas. And joining us now with more insight from Washington is Bloomberg's Fed and economy reporter Enda Curran. So, Enda, all signs, I guess, point to Kevin Hassett. Certainly in the betting markets, the odds of Kevin Hassett winning the Fed chair have risen dramatically and others have fallen. What does this mean for the bond market?
Well, clearly the president has said, Matt, that he has a choice made. He hasn't announced who it is, but he's clearly decided that. And it suggests that the process is more or less completed, even though we're told some of those interviews carried on last week and a shortlist was expected to go to the president. Nonetheless, we do expect an announcement this side of Christmas. That's what the guidance from Treasury Secretary Besson has been. Whoever does come out of it, and as we say, our colleagues have reported that Mr. Hassett is leading the pack, is obviously expected to be a dove, Matt. Like you say, I mean, President Trump wants lower borrowing costs. He wants lower interest rates. He's been explicitly critical of the Fed since he came back to office in January about where policy is, very critical of the institution, very critical of Chair Powell. So whoever comes in will probably have to be delivering on at least some of President Trump's political agenda. But they'll have to do that while, of course, maintaining confidence of the market, of confidence of investors, that the Fed does remain independent, that it is pulling the levers in the interest of the economy, not of the political cycle, and that they will remain independent of ultimately not at the beck and call of the White House, so to speak. So clearly, it's going to be a very tricky balancing act if it's Mr. Hassett or anyone else when they do come in as Fed chair next May.
What has to happen for Kevin Hassett to take this job, if indeed he gets picked? Does he need to go in front of the Senate for confirmation, for example?
Yeah, there are some mechanics involved in all of this. Number one, whoever gets picked, Mr. Hassett or otherwise, will need confirmation from Congress. They will have to go through that process. That could be quite a long and bruising process, depending who the candidate is. The Democrats, of course, will have question marks around Fed independence and whether or not this new person will just be an extension of the White House. Of course, the Republican side will have to see how they weigh up and scrutinise their own concerns when it comes to the Fed. And then once you get beyond that, Matt, there's a technicality of making sure that there's a vacancy on the board for this Fed chair. And if it was Mr. Hassett, for example, in that case, existing or current Governor Myron would probably have to step off the board when his current term wraps up at some point early in the new year to allow Mr. Hassett a space if existing Chair Powell decides he's going to stay on. So there's some mechanics there and chess pieces in terms of the composition of the board itself. But ultimately, whoever the president picks will be expected to sail through that process.
We have the next Fed meeting on or decision released on December 10th, right? And we get the change in non-farm payrolls that was delayed on December 16th. Is there any chance that they'll move their meeting until after they get that information in order to make a more informed decision?
There hasn't been any public commentary or signalling on that point from the Fed, Matt. Clearly, it's a very unusual situation coming out of a government lockdown. We're not going to have official inflation data or official jobs data before the meeting next week, like you say. That said, though, you could also argue that plenty of Fed officials have said they've had all the data that they need from private sector sources and from state level. And it seems like the policy committees is at a point now where you're either more worried about inflation or you're more worried about the labour market. And we certainly had plenty of dovish comments towards the end of as we headed into the Thanksgiving break and as we headed into the current quiet period for the Fed, indicating that the doves perhaps were winning out in terms of that debate. So I think there's a view among Fed officials. They've made up their mind. It's not clear whether or not the official data between now and next week would really change that for them.
Yeah, it looks like futures pricing in right now a 96% chance of a cut. Enda, thanks so much for joining us. Bloomberg's Enda Curran covers the Fed and the economy for us out of Washington, D.C. Coming up, Citi's Stuart Kaiser sees a tug of war between negative short-term momentum and positive seasonality for stocks. He joins us next here on set. This is Bloomberg Open Interest. RBC strategists see the S&P 500 rising more than 10% for a fourth straight year. The team led by Lori Calvasina sees the benchmark hitting 7750 by this time next year. They say earnings growth and Fed rate cuts will offset doubts around inflation. Joining us now is Citi's head of U.S. equity trading, Stuart Kaiser, here on set. So I guess it's not a tough call to make if you figure whoever is the next Fed chair is going to cut rates pretty drastically.
Yeah, I mean, I think the question, though, there is why are they cutting rates, right? If you look at market pricing, you're pricing less than about a 33% chance of cuts in all the meetings until June, right? You know, to get the odds of those cuts up, what has to happen? And I think that's the big question. Is simply naming a new Fed chair enough? Or are we going to have to see weakness in the labor market and the growth side of the economy? And if that's the case, you know, then that becomes a little bit of headwind for equity markets. So I do think we're getting to the point now where the Fed is basically data dependent. And now you have to sort of, you know, game theory your way through of what data am I getting to justify those cuts, and what does that mean for equity markets?
I mean, Masayoshi Son, the head of SoftBank, said whoever thinks there's an AI bubble is not smart enough. AI just becomes 10% of GDP, it will be huge returns. But that's a giant leap from here, right? Does that continue to drive the market next year?
I mean, I think it almost has to continue to drive the market next year to some degree. Look, I think if you're being bullish on the market outside of AI, I think you have to be of the view that you have some stimulus hitting the economy early next year from the new tax and spending policy, and then that's going to sort of stimulate consumer spending and support stuff. If you don't get that sort of stimulus into the economy, ex-AI, then yeah, I think you're kind of reliant on the AI trade here, especially with the Fed kind of now fully priced, right? The tighter credit spreads and lower rates have really helped small cap, kind of rally, underneath the surface. If you take away those rate cuts, you either need a broadening of U.S. economic growth, or again, yeah, you're sort of tethered to that AI trade.
Do you see, just 30 seconds till we have to take a break, but do you see a broadening of gains in this stock market? Because I noted the S&P equal weight index has moved up for 5 days in a row, so they're starting to come back a little bit.
Yeah, I do think clients are of the belief that the big, beautiful bill is going to stimulate the economy early next year, and that should support broadening. Whether that happens, I don't know. Whether investors will try to trade it, I think that is the case, and I think you're seeing early signs of that as we get late into the calendar year.
All right, Stuart, you're going to stick with us through the opening bell. You'll be with us for the first opening bell of December. It's an historic moment with Stuart Kaiser. In terms of the futures here, we do see losses across the board, and we're going to get into the seasonality. I may pull up the SEAG chart on the S&P 500, because if you look over the last 29 years, December is a good month, up 0.9%, but last year was a bad December. And if you look over the last decade, we're actually showing just slight losses for the month. So what happens now after 7 months in a row of gains for the S&P 500? Can we continue to climb? We'll find out. This is Bloomberg. Moments away from the start of trading on this first day of December. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at kind of a dour start to the month, with futures down 0.7% on the S&P. NASDAQ futures down a little bit more, about 0.9%. But to lift your spirits, we have the Partnership for New York City ringing the opening bell at the New York Stock Exchange. Catherine Wild, who leads that think tank, I believe she is stepping down after decades of leadership. They're ringing the opening bell. Down at the NASDAQ, you've got a bank holding corporation, Banner, ringing the opening bell, celebrating its 30 years, 3 decades of listings. And if I look at that stock over the last 5 years, it's up about 75%, so doing fairly well, not as good as the S&P. In terms of stocks right now, we have Nvidia kind of weighing on sentiment, weighing on the indexes. It's obviously very heavily weighted, the biggest company in the entire world, and it's down 1.4% in the cash trade. It's made a $2 billion investment in Synopsys, buying those publicly traded shares. That's boosted Synopsys 5.33% this morning. And then MicroStrategy right now down more than 6% because Bitcoin continues to fall. It's, I think, below 86,000. At one point this morning was below 85,000. And the CEO of Strategy saying if their MNAV falls below 1, that they would sell Bitcoin. That's a little bit technical, but essentially the value of their company compared to their almost $60 billion in Bitcoin holdings. Let's head back over to Citi's head of U.S. equity trading strategy, Stuart Kaiser, at the desk. And, I was saying earlier, Stuart, it's so strange to read the Bloomberg stocks story and see that Bitcoin is seen as leading this market. I mean, is this asset really big enough to be the tail that wags the dog?
I mean, I don't know if the asset's big enough. I think the sentiment around it is viewed as important. You've also seen a significant pullback in retail trading activity within the equity markets. So I think equity investors are seeing Bitcoin lower. They're seeing retail participating a little less in equity markets, and are maybe a little bit concerned that that sentiment's been dented on that side of thing, and maybe that sort of bid below the market is not as sort of evident as it has been for most of the year. So I think Bitcoin's being viewed more as a sentiment indicator than specifically kind of a pass-through from an asset perspective.
Why would sentiment be bad, since, you know, we have these companies investing trillions of dollars in capex. We have double-digit earnings growth that's expected to continue at least in the low single digits, or in the high single digits, I should say, next year. We just talked about RBC raising their outlook, and they're not alone, right? Isn't everything looking pretty rosy as the Fed is going to cut rates? We're getting stimulus from the big, beautiful bill. We may get $2,000 checks in the mail.
Yeah, I think if you pointed to two things, one would be consumer earnings this earnings seasons were a little bit messy, and management certainly talked very cautiously about sort of sentiment and the health of the consumer spending. And the second would be on the AI side of things. The reaction function has definitely softened, right? You know, you had Nvidia traded down on earnings, Palantir traded down on earnings, Meta traded down on earnings. We've all seen what's happened to Oracle's share price. So, you know, I think the sentiment and the valuation on the AI side is getting kind of an audit, so to speak, from the investment community, and more importantly to me would be that retail side of things. Seeing retail participation pull back at the same time that consumer earnings are showing some weakness. I think those are the two things, if you're getting a little bit more cautious, you'd probably point to.
I wonder what you think about Nvidia. I mean, if you get chips from Google or maybe chips from AMD that start to be as good as Blackwell, or at least better at other things, if you get a shift in that leadership, is that bad for the market, or is it good that we have more players?
You know, it's tough. I mean, it's definitely a headwind for Nvidia and some of the leading semiconductor stocks. You know, same as we saw from DeepSeek back earlier in the year. And you could argue, yeah, that's bad for the semiconductor stock, but cheaper, faster, and more access to AI is actually better for everybody else.
Yeah.
You know, the problem is, as you mentioned, Nvidia is the largest weighting in the S&P 500, so it can negatively impact the index. At the same time, that big picture, it's probably a healthy thing, you know, for the global economy. And I think people are looking at it just that way. It's tactically, it's a risk. But structurally, it's probably a net benefit if it plays out that way.
Wow, Nvidia, by the way, currently at $4.25 trillion. So it's actually lost $750 billion in market cap over the past couple of weeks.
It's all rounding error.
Is the retail sentiment, I mean, is it that important right now? Are retail investors really big enough to drive this whole market?
I don't know if they're big enough. I think it's a little bit the same as Bitcoin. It's really a sentiment issue. And even your institutional investors are aware of retail participation. They're aware of the stocks they hold. And when they see a change in behavior, that kind of implies a change in the supply demand of the market. And I just think it makes people a little bit more cautious until they're confident that things have settled down. I mean, you know, we estimate retail was about 15% of the market from a volumes perspective late in October. That's down to 10. It's a significant pullback. So again, it's the flows is part of it, but it's also the knock-on impact it has on sentiment and risk management on the institutional side, I think.
If you have a big client, if you have a whale calling the city trading desk and says, I have new money to put to work, what do you do with it?
I wait till year end. No, look, I think into year end, we do expect the markets to rally, and we think what's worked in the first 11 months of the year.
By the way, wait till year end is a fine answer. You know, I mean, that's okay. It's only 1 month away. So
unfortunately, people will push back if I give them that answer. Look, so into year end, we think seasonality will take hold. We think your year-to-date winners are going to lead you. As you get into early next year, there's a lot of interesting, you know, you mentioned S&P equal weight. There's a lot of interesting rotation, I think, opportunities. Healthcare has caught a bid recently, whereas we're seeing supply of financials, for instance. Financials have been an overweight, you know, healthcare have been an underweight. So I think as you get into early next year, you do want to look at some of these rotations and leader laggards trades. But from now until year end, I think you want to play straight down the middle, be long equities and be long the winners, because we think that's what's going to drive you into year end.
We finally have $1 trillion healthcare company, right? Eli Lilly eclipsing $1 trillion in market cap with its weight loss drugs, Zepound and Mounjaro. This isn't a theme that it seems like investors are playing as much as, you know, it affects the consumer economy. What do you think about these healthcare companies and these weight loss drugs?
Look, I think healthcare has faced like two pretty big headwinds the last couple of years. You know, number one was you had a regulatory environment that did not allow M&A. Right? So that took the valuation premium away from smaller biotech companies, et cetera. And secondly, that meant your large cap companies, other than the obesity drugs, were kind of starving for growth because they would normally buy the growth from those smaller companies. So I think what you're seeing now is the valuation has gotten pretty low. People are viewing it as a more positive regulatory environment. Lower interest rates have helped. And all of that has gotten people saying, you know what, maybe this has underperformed too much and maybe we want to step into it. We've been pretty bullish on healthcare for, I would say, the last 4 to 6 weeks around the obesity week. week, we kind of thought that would be a little bit of a catalyst, and it has been. But look, big picture, the question
this week is obesity week?
Well, obesity week was a couple weeks ago. They did it before Thanksgiving.
I see, because it feels like it was obesity weekend.
It does feel that
to
way.
me. But I mean, Lilly's up 47% in the last 3 months. I mean, it's really, the slope has changed.
Yeah, no, it has. And I do think, the M&A story, the laggardship of the market, lower interest rates, and people really getting behind the idea that the government may be willing to sponsor purchases of those drugs in a more substantial way has been really positive for the space.
Oh, you know what? Joe in the control room prepared the seasonality chart. We might as well look at it since he put it together. We have this great function on the Bloomberg terminal, SEAG. You can use it with any index, maybe individual stocks as well. And here is a look at the last 10 years. It's a little bit confusing, but the top line is the average, right? So even though December is traditionally a good month over decades, over this decade, it's turned down. You're still confident in a Santa Claus rally?
Yeah, we're still pretty confident. I mean, December 2018 was obviously a pretty tough one, but big picture, if you go back 30 years, 40 years, 100 years, December's always been pretty positive, and we ultimately think that'll happen.
Yep.
I think last week was a good test case. We didn't have much news. It was a very quiet week, and we kind of started to drift higher. So that kind of shows you that no news is good news in this case. The Fed's now kind of fully priced. So I think that December 16th date, when we get the dual payrolls prints, is probably the most important day for the rest of the year. But yeah, we do expect seasonality to kind of kick in again.
All right, Stuart, great having you here. Thanks so much for joining us. Stuart Kaiser there from Citi is the head of equity trading strategy at the bank. Let's get a check on the stock market right now. On a broader sense, you see the S&P 500 is down just about 32 points, so a drop of about 0.5%. This is the move screen, so you not only see the breadth here, 116 stocks up, 385 down, but you can see a breakdown of who's helping and who's hurting. So on the upside, Amazon is adding 2.5 points. Then you've got Lilly adding almost 1 point, well, 0.6 of a point here. Synopsys also notably adding about 1/3 of a point, and it's a much smaller company, of course. On the downside of the ledger, you've got these AI plays, right? Broadcom dragging the index down by about 7 points, 6.5. Microsoft by 4.5 points. Nvidia dragging the index down by 2.5 points. And then you've got Facebook, Apple, and Google, as well as Palantir and Oracle. So the AI trade is really what's hurting us. Let's take a look at the GRR. This is group ranked returns on the SPX L1 index. And energy, as the spike in oil continues this morning, in that trading, you can see that pushing up energy producers and consumer discretionary, as well as consumer staple stocks. So consumer doing well on this Black Monday, or sorry, not Black Monday, Cyber Monday. Black Monday would be far worse than a 0.5% drop. The utilities index is the biggest loser here, but you can see IT is also a loser, down 1%, and communication services, which these are the hyperscalers right now, just off about 0.75%. Coming up, stocks and crypto start December on the back foot. A closer look at tech sentiment with Mandeep Singh of Bloomberg Intelligence next. This is Open Interest. Time now for top calls, some of the analysts' action and focus this morning. First up, UBS initiates Carvana with a buy rating, saying its online platform is attracting more used car shoppers. The firm's highlights, the firm highlights, I should say, UBS highlights Carvana's strong customer experience and technology advantage, saying that this edge should help it capture share in a fragmented market. Next up, JP Morgan names ASML as its top semiconductor pick, saying the company is best positioned as chip makers prepare for a new long stretch of investment sparked by improving memory prices. I believe ASML actually designs the chips, doesn't really actually make them. And finally, Guggenheim is boosting its outlook on Alphabet, arguing that Wall Street is still underestimating how much revenue Google Cloud can deliver over the next few years. The firm points to strong backlog growth as evidence of a plausible bull case that could generate $40 billion more in revenue than the consensus expects. That's interesting, and let's talk about that. Get the general tech outlook with Bloomberg Intelligence Global Head of Tech Research. Mandeep Singh joins us here on set. ASML makes the lithography machines, right? So they don't make the chips or really design them. They make the gear that makes them.
Yeah.
Just wanted to get that straight.
Yeah.
All right, what do you think about this Google call? I mean, it does look like they could generate significantly more revenue than the street expects, especially now that we know about the TPUs.
Yeah, and look, I think everyone is thinking about the total data center capacity that'll get added in 26, 27. And so from that perspective, what has changed is previously OpenAI told us they're going to be adding 26 gigawatts, 20 gigawatts on their own, 6 with AMD. Now I think everyone is realizing, one, they may not have the ability to pay for those 26 gigawatts. Second, because Google is so much more efficient with their CapEx, they may have an advantage in terms of adding more capacity that gets translated into cloud revenue. So really, everyone is still excited about GenAI build-out. It's just who builds what. And Google certainly has an advantage with the vertical stack they have.
I also wonder, you know, the wealthiest consumers in the world probably overwhelmingly use an iPhone. And when you buy the phone, it comes with some software, some apps already on it. I figured it would come with ChatGPT preloaded in the coming years, but it may come with Gemini 3 preloaded, or 5 or 8 or whatever generation we're on. Do you know anything about what's coming on that?
I mean, especially with Apple, it wouldn't surprise anyone if Gemini is preloaded, because Apple has been using Google for the past 10 years for a lot of the defaults, which is why Google pays those $20 to $25 billion to Apple. And look, I mean, a thing like large language model, which we know Apple hasn't invested in building their own large language model, it makes sense for them to rely on an existing partner like Gemini, where they don't have to pay as much to a default LLM as they may have to pay for OpenAI. So from that perspective also, there is a very high chance that Apple ends up using a Gemini. I don't know if it's going to be preloaded, but it will be one of the default apps that'll be running on it.
What's the expectation for an Apple? Because it has underperformed, for example, Google significantly, and obviously Nvidia, and others in the AI space as well. But you note that investors are starting to reward companies that are efficient with CapEx. So not getting involved in this dogfight is pretty efficient to begin with, isn't it?
And look, right now, 3 or 4 companies are trying to train the same most powerful LLM. So think about what the Gemini 3 did, was to release a set of features that OpenAI will try to replicate. Is it really very efficient for investors to pay these companies to invest in training their LLMs when the functionality converges to a point where all 4 LLMs will have similar features? And that's where the market will be more discerning in terms of figuring out who they want to spend versus who they don't want to spend. And I think we may be close to reaching that moment in 2026, because you just want to, I mean, these companies are talking about billion-dollar training runs where you're spending $1 billion in training a model, and guess what? The output will be similar to an existing model.
Right,
it's just not very efficient.
By the way, to be fair to Apple, it hasn't underperformed everybody. I always look at a 5-year snapshot because the comp function defaults to that. Amazon is a huge loser compared to the rest of the Mag 7. And they have such an incredible cloud business, right? They must have a capable LLM in training. Are they not going to cash in on that?
Actually, they don't. So even though they have their own Nova LLM, it is still way behind the frontier LLMs, and they have a partnership with Anthropic. So from that perspective, being that incumbent public cloud market share leader with over 50% share, when I look at all the other cloud providers like Microsoft and Google, AI is almost adding 20 percentage points to the growth. So Microsoft grew 40% this quarter. 20 percentage points came from AI workloads. That's not the case with Amazon. Amazon grew 20%. AI contribution could be maybe 2-3%, maybe 5% at best. So from that perspective, Google and Microsoft are getting a much bigger contribution of AI infrastructure workloads than Amazon is, and that probably explains why they haven't benefited as much.
Yet. Because Nova is a star that increases in brightness at a sudden and rapid pace, up to 14 magnitudes. So maybe. Mandeep, thanks so much for joining us. Mandeep Singh there runs our tech coverage for us at Bloomberg Intelligence. Coming up, Barrick shares rise on news of a potential IPO of its North American assets. We'll take a deep dive into the gold miner next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing to kick off the week and the month. S&P 500 down 0.4%. So looking a little bit better than futures, looking a little bit better than it did the very first few minutes of the cash trade. And I'm over my shoulder here, out of the corner of my eye, you can see that Nvidia is rising. So that could change things. I do want to look at not the big indexes, but Nvidia up right now 0.4%. So a turnaround there that could help to lift things. Alphabet shares, Google down 1.3%. This was the story of last week, right? The rivalry here in terms of GPUs and TPUs. Disney had, I guess, a good weekend because Zootopia 2 came out, and it was okay. I don't think it was as good as Zootopia 1, but my 5-year-old daughter loved it. Warner Brothers, the deadline for the new bids that they're seeking is today, so there's a little movement there, but not much. Gold, even less movement, but we're showing you that because we're going to talk about Barrick right now. Maybe on its way to an IPO for its North American assets. It's mulling that. It's considering. It's probing the possibility there. For more on this story, we're joined by Bloomberg senior markets reporter Bailey Lipschultz. Bailey, I'm going to walk off set here and over into yours.
I'll wait and see you. Yeah. Over here.
So what do we know about the Barrick story? As you know, this underlying asset doing nothing today, but over the past year has just rallied so far so fast.
Yeah, rallied very strongly, just given kind of overall sentiment. The big news is that the board approved management to consider IPOing their North America assets primarily. It's going to be partnered potentially with a larger mine in the Dominican Republic. But the big news from that is when you look at this Nevada mine, it's really been undervalued according to analysts. Bloomberg Intelligence saying that the North American assets could be worth nearly $62 billion by themselves. Why does that matter? Overall, right now, the stock, at least on the U.S. trading, valued at $72 billion. So when you look at this potential unlocking a lot of opportunities, the big pitch from analysts and kind of the management team is that this can kind of narrow the gap relative to rivals, which has been something that has been weighing on the company.
Right, and the reason that we invite you on the show to talk about this story is not because you know so much about gold or Barrick, but because you know so much about IPOs, because you cover that part of the market. How are the animal spirits? How are IPOs looking in 2025?
So far this year, it's been relatively mixed. The pullback that we've seen in the last month really did dent some of that appetite. We saw mid-November before that pullback, the average stock was up 22%. That at one point was essentially flat. Now we are still seeing a rebound. We do see investors wanting to put money to work. Mining companies and things in the gold and more defensive space are going to be interesting just because a lot of investors do want these growthy assets. They want to chase the crypto names. But when you really look at the companies that end up being some of the biggest winners, they are in the defensive space. We're looking at potentially seeing a Medline filing, which will be a huge healthcare company in the next few weeks, trying to get out before the year-end holidays. So when you look at overall appetite, we are up year over year for the third consecutive year, not quite back to the pre-pandemic norms, but we do see pretty good demand so far in 25 and a lot of excitement for next year.
I will say I had forgotten we have a function IPO Go, and you can click on the time series tab in IPO Go, and you can see the value, which has shot up, the deal count, which has dropped significantly, and it's just a fun function to play around with on the Bloomberg terminal. I'm not advertising it any further than that. I'm just telling you.
It is a good tool, but it does take a little bit of effort to know what you're looking for.
Here's the value picture of the time series. Check it out. Play with it on your own terminal. Bailey, thanks so much for joining us. Bailey Lipschultz there. Coming up in the next hour, Liz Ann Sonders joins us as we kick off December. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Danny Berger is off. We're looking at a little bit of a negative start to the month of December, but it's getting better as Nvidia turns to gains from losses. In terms of what we're watching on the economic front, we have data coming in as usual. ISM manufacturing coming in a little bit lighter than expected, a little bit lighter than we saw in the previous reading as well. So 48.2 is the level compared to a survey of 49 and a prior reading of 48.7. Prices paid a little bit more than expected. 58.5. We were looking for 57.5, and the previous reading was 58. So those are both going in the wrong direction. Let's bring in Charles Schwab, Chief Investment Strategist, Liz Ann Sonders, to talk about the broader market and economy. She says traders are buying the dip and seasonals are generally supportive of a year-end rally. And Liz Ann, well, first of all, thanks for joining us. Good Monday morning.
Thanks for having me. Good Monday morning to you too, Matt.
We looked at the seasonality chart, and we see that because of 2018, this decade doesn't look great. But if you look over the past, say, 30 years, December usually gains 1%. Do you expect a Santa Claus rally into the end of the year?
Possibly. It wouldn't surprise me, though, between now and then where we get a bit more choppiness and weakness. I think some of the position unwinds are maybe not sort of fully baked in, but then to see a bit of a rally, particularly after the Fed meeting, which is sort of that near-term moment of uncertainty that has been part of some of this recent volatility in the market, it wouldn't surprise me to see another year-end pop.
Does it puzzle you to see that futures are now pricing in a 96% chance of a cut? Are we all on board that a December cut is definitely happening?
Well, the Fed doesn't tend to buck market odds when they're as lofty as they are right now, but it wouldn't surprise me if we got what is often termed a hawkish cut. You could argue that if the Fed is thinking maybe there's a moment where a pause might make some sense, maybe it's better to provide that cut now, given market expectations, but then essentially telegraph a pause as opposed to having cut at the recent meetings, then say we're pausing in December and then telegraphing another cut, given the absence of data. So, in my mind, that's the most likely scenario: is the Fed cuts, and in the statement and reinforced during the press conference, it's a little bit more of what we heard last time, which is let's not assume we're on this continued path of additional cuts to come, at least in the near term.
If you zoom out, though, Liz Ann, I guess it doesn't really matter so much what happens in December. If, President Trump picks a dovish chair, Kevin Hassett or any of the other candidates, and we do get a terminal rate at 3% or even lower in 26, 27, is that great for markets?
Well, first of all, the C in FOMC does not stand for chair; it stands for committee. So this is these are decisions that are made by committee via a voting process. And I think what's maybe interesting as we head into what everyone is assuming, and I know you guys are reporting, it's going to be Hassett, that the greater willingness for dissent, for voicing opinions and perspectives about the path for monetary policy against some, sort of standard chair-driven view, like under the days of Alan Greenspan. I think it's an interesting time, and I would expect that there will be bigger differences in terms of the voices as we hear Fed speakers out on the road. But I also think on a going forward basis, like we have seen in the recent couple of meetings, greater number of dissents, possibly in both directions, which may be a way to reinforce the independence of the Fed and the ability and willingness to buck any one particular voice.
All right, so that's the macro look, what's going to happen with the Fed. If you step into this market of stocks, Liz Ann, and look at the valuations, we saw in a John Author's piece this morning that valuations for the cap-weighted S&P 500 that we all know and love are up around 25, whereas the equal weight is still at 20. Because these, Mag 7 stocks, and Nvidia in particular, are pulling us so much higher, does the concentration risk concern you?
Well, here's the thing about the Mag 7, and I think we're going to start to see maybe less of a focus on that particular cohort of 7 stocks, because none of the 7 rank in the top 10 from a price performance perspective.
And in fact, none of them are the #1 contributor to year-to-date S&P returns. So I think that's a really important point, because I think many investors conflate contribution and price performance. Nvidia is still the second largest contributor to S&P gains, but it's ranked worse than, I think, 60th in terms of ranking within the S&P 500. Broadcom is now the #1 contributor to S&P returns. It's among the better performers. It doesn't happen to be in the Mag 7. So I think next year might be the year where there's a little bit less of sort of this unifocus on that particular cohort of names.
Well, we have seen the equal weighted index. By the way, I'm showing the chart where you can see the valuations, the earnings multiples have separated. And the reason we note from 3 years ago is because today, I think, or Friday was the 3-year birthday of ChatGPT. So that's a huge driver there. We did see the S&P equal weighted index rallying the last 5 sessions in a row. Are you starting to see that broadening out? And do you think the all-important retail investor is dipping her or his toe into that as well?
Yeah, I think investors across the spectrum, inclusive of institutional investors, are looking to take advantage of some of these rotations that are happening. And I don't think it's just purely a rebalancing that tends to kick in when you get to the last month of the year, either rebalancing strategies on the part of individuals or the more formulaic rebalancing strategies on the part of many institutions. I think there really is a thirst and a desire to find opportunities outside the mega cap leadership or prior leadership areas. And I think that is likely to persist. Now, I think equal weight is pretty interesting here right now. That said, I think it may be still at this point a stretch to say that's going to be linear and that we're going to see persistent outperformance by equal weight. But I think we're going to see fits and starts of it. I think there is a lot of money looking for opportunities, whether it's because of valuation concerns, frothy sentiment concerns, leverage to any sort of additional easing on the part of the Federal Reserve. There's lots of sort of fundamental rationales why that would exist. And I do think that is going to continue, but importantly, not in a linear fashion in fits and starts.
All right, well, we'll continue to watch for it and really appreciate your time this morning. Liz Ann, thanks so much for joining us. She is the Chief Investment Strategist over at Charles Schwab. Now, the broadening may be something worth paying attention to, but we're going to focus in on Nvidia right now because it did flip into the green earlier after disclosing a $2 billion share purchase of Synopsys stock. Bloomberg Tech co-host Ed Ludlow joins us now to talk about what this means and why. So, Ed, I gather Synopsys designs or makes software that helps to design chips, right?
Yeah, it's the tool by which a chip is designed, but also validated. So before you send a chip through the fab to be manufactured, you test that actually the design is going to work. And it's really interesting because Synopsys is a supplier to Nvidia. They use that software platform. The stock's up 5%. Nvidia bought these shares at $414.79. It's now up near $440 a cent, taking between 2 and 3% of the company, replicating a playbook that you and I have discussed with Nvidia a couple of times this year. They took a stake in Intel in what was an engineering partnership. They took a stake in Nokia, which was also an engineering partnership in the telecoms domain. So there is some questions about, well, what does Nvidia get out of this? Synopsys is used by basically anyone that has their own chip designs, right? And so there's an argument that this gives Nvidia a sales channel. Synopsys will say, our software platform is so much better when it's run on Nvidia GPUs. So if you want to use our software to design your chips, you should also use it with Nvidia GPU to power that compute.
It seems like Nvidia, it's almost like an investment business as well as a chip maker. They have stakes in so many other companies.
Yeah.
It's got to be a huge portfolio. Is this part of the strategy?
I mean, we've had the opportunity to discuss this with Jensen Huang several times this year. Every time I've asked him what's the rationale behind taking 2 to 3% of a company, he basically will say, I thought it was going to be a good investment. And particularly in October when we were in DC and they made the Nokia investment, that day Nokia stock jumped 20% and he almost joked with me, well, I was pretty genius move, wasn't it? His words, not mine. But, it's kind of separate from the circular financing debate in that, they take equity positions where their bet is that the technology partnership moves the field forward in some way, and they get a return on the stock different to, say, lending money that's discussed in Ian King's Tech Daily today, the circular financing versus backing up loans debate. For Jensen, it's a very simple calculus. Is this or is this not a good investment? And they've got some cash to spare right now.
The debate or the story really of last week was Google TPUs and how efficiently they power Gemini and also Gemini versus ChatGPT. John Authors has a great column today wishing ChatGPT a happy third birthday. How does this all seem to be shaking out? Because it seems that that SoftBank's CEO Sun was so sad that he almost cried when he had to sell his Nvidia stake, but he needed the money to invest in OpenAI. Like, what if they're not the ultimate winner?
Yeah, I followed this story from the beach last week because, as you know, I took a break, but it was kind of interesting to take a step back. The very simple argument for those that are still bullish on Nvidia and discount the threat of a Google TPU is that Nvidia is still supply constrained. They will sell every single GPU that TSMC can manufacture for them. And their margins are high, so there's no price pressure. There's no suggestion that Nvidia is having to discount to ward off some of that threat from TPU. TPU is also not that new a thing. I think this is what's so interesting. It's come up in the news flow because Google has started to do deals with third parties. The latest reported one that spooked the markets was Meta, right? But they had previously tried to make the TPU available to third parties with less success. And right now, from a volume perspective, Nvidia still holds 90% of the market, which when I grew up in the Bloomberg newsroom studying from you, that's a technical monopoly, right? And that's an enviable position to be in.
Well, now the teacher learns from the student. Ed, great to have you on the program. Look forward to Bloomberg Tech kicking off in just about 48 minutes. Ed Ludlow talking to us about Nvidia, which has turned around this morning and may drive a change in markets as well. Though they're still down 0.4% on the S&P. As you can see, the NASDAQ off about 0.5%. Coming up, private credit bulls are on a mission to stomp out rising hysteria over the so-called cockroach risks. Danielle Poli, Oaktree Capital Management Assistant Portfolio Manager, joins us to talk about this next after Paul Davies wrote an interesting column on it. And Marc had a lot to say about it last week. Everybody's weighing in. We'll talk about it with Danielle next. This is Open Interest. Let's get to high interest now. Look what's making headlines around the world. Ukraine launched a record wave of drone strikes on Russian oil infrastructure last month, hitting refineries at least 14 times and damaging Black Sea export terminals. The escalation comes as the U.S. pushes for new peace talks, and both Russia and Ukraine intensify attacks on each other's energy systems ahead of the winter season. Strategy set aside $1.4 billion cash reserve to cover nearly 2 years of dividend and interest payments. The move aims to ease fears it may have to sell Bitcoin as prices slide. The company also cut its 2025 earnings outlook as it assumes lower Bitcoin prices. And New York City will likely have a slick commute tomorrow, while the rest of the Northeast gets a dollop of snow from a storm rising up from the U.S. Gulf Coast. The storm will likely spark travel delays across the region and put more pressure on the U.S. air traffic control system, with planes needing to be de-iced and runways kept clear as high winds sweep across the region. So be prepared for your travel time to be much longer. Turning to the growing fears in the private credit markets. In his latest column out this morning, Bloomberg opinion columnist Paul Davies writes, quote, defaults among junk-rated private borrowers have climbed steadily since U.S. interest rates began rising in late 2022. The trailing 12-month default rate hit 1.3% of all loans this summer, which doesn't sound like much at all, but it's up from less than 0.5% in August and September of 2022, according to S&P Global. Joining us now is Danielle Poli, Oaktree Capital Management Assistant Portfolio Manager for Global Credit Strategy. And Danielle, this just adds to the concerns we've had from a spate of bankruptcies that may well be idiosyncratic issues, but nonetheless, investors are worried. What do you say?
Termites are not eroding the foundation of private credit. I think that's the key. And so while we have seen defaults increasing, we should dissect that a bit because the entire market shouldn't be painted with a broad brush. I'll start with the best. The high yield bond market, defaults are actually low. They're below historical averages, and that makes sense. This is a high quality market, over 50% double B in this market right now. Defaults are increasing, they're elevated in the leveraged loan market, as has been pointed out, a little bit above historical average, which makes sense because a lot of the issuance of the low rate period got done, and those borrowers now have higher rates and are defaulting at a higher clip. But really, where the maybe mass defaults are lying is in private credit. And I think that that's where investors get concerned. But you need to focus on non-accruals, PIK interest. Not all PIK interest is created the same. So maybe bad PIK, you're getting around 5-6%. That's an elevated default, but not so high that as a credit picker at Oaktree, we can't find good loans to give to our clients to offer them an attractive income.
All right, I'm not as well versed in this stuff as my colleague Dani Berger, so it's a horrible time for her to be off. But I know that PIK stands for payment in kind, and this is what is it? Not at all a default, but a reworking of the credit covenant where they'll add interest to a loan if the borrower's having a tough time?
That's exactly right. So instead of paying that interest in cash, it'll be paid in additional, effectively shares of a company or just increasing your outstanding loan amount in the case of credit. And what it does is allows some flexibility for that borrower to get things in order instead of going into a traditional default and handling it in court through a bankruptcy.
So is that market getting bigger? Because that seems troublesome, I guess, from some
it's an early
people's point of view.
That's
also,
right.
From others, maybe an opportunity, right?
Right. I think if done appropriately, it can be an effective tool. So for us, we will look at PIK, but we often like to have 50% of it in cash, so a bit of protection. What's really important is in the private credit market, you have bilateral agreements with your borrowers. You're able to spot things early. You're able to partner with them to help provide these types of solutions and maybe get to a better rate environment. It looks like we might get this cut in December, and it looks like the trajectory of rates is going to be down, which generally should be good for borrowers.
So how does the market look right now? I'm always scared of everything, so I don't have the courage.
Investor.
Okay, good.
Yes.
But whenever sometimes I talk to Howard Marks, your boss, and he'll say I'm not scared, and there's not enough opportunity. He wants more, right?
Yes.
Do we have that opportunity right now, or is it still looking pretty sparse?
Well, the kindling of the fire, I guess, is there, right, with the lax lending standards and some of the complacency issues we've seen, especially funding AI. I mean, there's just been a lot of deals that are getting done that we're scratching our heads about. We're remaining very disciplined because we do think that we're late in the cycle and there could be opportunities for us at Oaktree to do more rescue lending, opportunistic distressed investing that we're known for as the cycle changes. But today, there's a lot to do in the core of the market. There are the tails, but if you avoid them, you can put together a high quality performing credit portfolio that's giving you a yield of around 7.5%, 8%, all liquid. And then beyond that, when you start incorporating private credit, which still gives a yield high single digits, in some case double digits.
So what I'm hearing from you is a lot like what I'm hearing from Marc Rowan or Mark Lipschultz when we talked to him at Blue Owl, which is, at least in part, that what really matters is the team that you choose to run this credit for you, right?
Yeah, that's
it's a
absolutely
differentiator.
Right. We're a bottom-up investor at Oaktree. Risk control is the primary tenet of our investment philosophy. We like to say, if you avoid the losers, let the winners take care of themselves. Income is so high, so if you can avoid those cockroaches, you will be great and you will get a really good return. I mean, credit today not only gives you a good income, but it's a place to hide out from the volatility in equities. Equity valuations are pretty high right now, and I think susceptible going into year end to some additional volatility.
All right, Danielle, great having you on set. Thanks so much for joining us on Open Interest. Danielle Poli there of Oaktree Capital Management. we had her on our Friday interest rate show, and I said we have to bring her back to the main event. Still ahead, Black Friday shoppers came ready to spend, pushing sales up more than 4% over what they were last year, despite the softer economy, or at least the view of a softer economy that you get when you look at consumer confidence. We'll get the boots on the ground view from retailers with Marc Rosen. He is the CEO of Catalyst Brands. They own JCPenney, they own Brooks Brothers, and Greg Hewitt joins us of DHL Express US to talk about shipping, the all-important indicator there. This is Bloomberg Open Interest. Bally's shares up after the casino operator and Steve Cohen bid for a casino in Queens, New York, won approval by the board. So we see that Steve Cohen, famed hedge fund operator, and Bally's are getting picked to run New York City casinos. And as a result, Bally's shares are up more than 10%. You can see from that action there. We're going to bring you more on this legal gambling in New York City, casino in New York City. Specifically, it looks like in Queens. And Steve Cohen, also owner of the New York Mets. And Joe will tell me in a moment how the Mets have done under his ownership, gets picked to run this casino. We'll talk more about that as this market continues to fall this morning to kick off December on a weak note, down 0.5% on the S&P 500. Coming up, Black Friday sales coming in strong as retailers are ready for Cyber Monday. We'll talk to Marc Rosen of Catalyst Brands next. This is Bloomberg. The U.S. consumer remains resilient. Data from MasterCard showing retail sales rose 4.1% on Black Friday. That surpasses last year's 3.4% growth. So better than last year and better growth as well. For a boots on the ground look at the consumer, we welcome Marc Rosen, Catalyst Brands CEO. Catalyst is the parent company of retailers like JCPenney, Brooks Brothers, Eddie Bauer, Aeropostale, Lucky Brand, Nautica. You know all the names. Marc, welcome to the program. Thanks for joining us here in studio. How was Black Friday and how is Cyber Monday shaping up?
Yeah, thank you for having me. So Black Friday was, as it always is, I think it's just a super exciting day for all of us in the retail business. I was out in stores that morning, and we had lines around the store at our JCPenney stores that morning of customers coming in for our 5 a.m. deals. They were waiting to get a snow globe, which is one of our historic nostalgic giveaways, but also a coupon book. I think consumers were really focused on value and deals this holiday. I will say the other big thing that we noted on Black Friday was Gen Z was fully in on Black Friday this year, and it was really exciting to see Gen Z shoppers out in the malls. Our Aeropostale brand did really, really well with strong sales and a really strong presence of Gen Z coming out.
It does feel like there's like a 90s comeback somehow.
That's right.
I don't know when Aeropostale really hit the first time, but there's definitely a second wave for these kind of brands. That's and right. You own a lot of them. How is that shaping up and what's driving it?
It's across the portfolio, right? I think the thing that brings our brands together is we have historic brands that the consumer knows and loves, and the thing that brings them together is it's also incredible fashion at a really affordable price. I think so. If you look at Aeropostale for the teen customer, all the trends, Y2K is actually the trend right now, right? It's the wide leg, the baggy, the low-rise denim, and that's doing really well. And so we're seeing consumers really come in for that. Brooks Brothers, which I know you're a shopper.
It's near and dear to my heart.
Exactly,
yeah.
Right? So Brooks Brothers also had a great Black Friday, and we're moving into Cyber Monday, but there it was all about sweaters. So merino wool sweaters, cashmere sweaters, and the quarter zip is actually we have a quilted quarter zip that was our #1 selling item on Black Friday as consumers are coming in for that.
What are the common themes among the brands? You've had significant growth over the past few years, and you developed a great portfolio of brands. What are the common threads behind all of these businesses that you've put together?
I think the common theme, if you put it all together, is really accessible fashion for the American consumer. with brands that they know and love. And that's really the thing is we've been able, as we put the whole portfolio together, if you think across JCPenney, if you think about Lucky Brand, and if you think about Aeropostale just as the primary brands for denim, and you think about the amount of denim that we source and buy for consumers across all of those brands, what the combination, which was just formed in January, has allowed us to do is put together all of that sourcing and really make sure that we're bringing the best value for the consumer by finding the best prices on denim and really giving that to the consumer on days like Black Friday. And in this time where the consumer is really value focused, that is what's making the difference right now.
So how have you navigated what's been a volatile year in terms of policy, right? Tariffs, I imagine, must have a huge effect on the amount you pay for textiles. How do you equal the hit of that in margins?
We work closely with our suppliers. Again, I think the combination this year was probably really well timed with tariffs to give us the combined volume of things like denim, like fleece, and looking at that combined buy across the total portfolio, and then working with our suppliers to get the lowest possible cost for consumers. And we've been committed to that throughout the year. At back to school season, we talked about it, but again at Black Friday, if you look at JCPenney, for example, well over half of the items that we offered at Black Friday deals match the pricing of last year, because that's really the job of our merchants, is to make sure that they can deliver that pricing for the consumer. At Aeropostale, we delivered the same promotion that we had last year, which was buy one, get one free denim. And again, that's our merchant teams working with our suppliers to make sure that we can bring that to them. And at Brooks Brothers, it was the cashmere and the merino wool sweaters, the same pricing as last year.
So, I mean, good deals for Black Friday and for Cyber Monday is great for the consumer, but you must have to take price somewhere, right? So what's it look like over the totality of 25 and going into 26?
Yeah, as we look across the total portfolio, again, it is the job of our merchants to make sure that they are working to get the best costing from our suppliers and deliver that in value to the consumers, and we mix that out across the total portfolio. And so we are really focused on making sure that the key items that our customers are looking for at the big moments like Black Friday and throughout the year like back to school, that we are delivering like item at like value.
In terms of 26, what do you expect for next year? Because the consumer has been resilient. The U.S. consumer is always resilient, right? Don't count out the U.S. consumer. But consumer confidence numbers were low. There's real worry about the labor market. And I was surprised to see such growth in this season. So what do you expect for next year?
I think the interesting thing about the consumer is we definitely see that the consumer has stretched wallets right now. But we also know that the consumer is going to make sure that those moments that matter for their families and the ones that they care about, that they are going to make the most for those moments. And so the consumer is going to have holiday and Christmas this year. What they're searching for is really more for value, and that's where we really win. I think, at JCPenney, for example, this was the 4th year that Wallet Hub named us as the best place to find Black Friday deals. So we're making sure that we have the deals, that we're showing the value, and that is what's really important to the consumer, because although the wallet's stretched, they're also committed to taking care of their families.
All right, Marc, great having you here in studio. Thanks so much for joining us on this Cyber Monday. Marc Rosen there of Catalyst Brands. Let's get a check of what's going on in the stock market right now. We are still seeing drops, actually 0.6% on the S&P 500 to kick off this December. Traditionally, December is a strong month for stocks. We've, over the last 30 years, have gains of about 0.9%. Right now, we're not looking like that. Coming up, the U.S. consumer remains resilient. As we've said, Black Friday sales rising. As we said, we're going to get another check on this economy. Greg Hewitt joins us, DHL Express U.S. Chief Executive Officer, on Cyber Monday, and the read on retail from a shipper's lens. This is Bloomberg Open Interest. Holiday shoppers are spending big. November sales jumped more than 7% year over year, according to Adobe. Now all eyes are on Cyber Monday. For a behind-the-scenes look at the logistics powering it all, we're joined by DHL Express U.S. CEO Greg Hewitt. And Greg, this is where we get a great read on the industry, on retail, because if you buy something, especially on Cyber Monday, it has to be shipped. What are you seeing?
Well, so far, so good. Thanks for having me, Matt and Dani. It's good to be on. So far, things look good. The routes are out on the road, getting deliveries from Black Friday done. We're expecting a lift of about 33% during this peak season. That's U.S. Thanksgiving to Chinese New Year versus our Q3 run rate. That's a little bit below what I would say our biggest peak seasons, but a good modest peak coming off a bit of a downturn this year with volumes down 30% overall. It'll be nice to see a lift during peak season.
What were the record years, Greg? What were the biggest peak seasons?
The biggest peak seasons would have been during the COVID years, where you not only saw everybody at home shopping online, you had things like personal protective equipment, you also had the vaccines moving around. Those produced our biggest volumes. But I guess with some of the changes in the regulatory environment this year, there was a lot of uneasiness, a lot of concern around what would volumes look like. It was great. We talked to 400 small and mid-sized businesses recently, and over 40% of them said that they were expecting larger orders this year versus last year. So that's good, some good optimism.
Yeah, I mean, we don't need to, we can go to stores and buy stuff. We don't need to ship everything. And of course, you have the tariffs, which I imagine would have been a headwind as well. But have you felt those tariffs? Has it been a problem?
Well, I'll say that it has created some volume declines, 30% year over year. It's also created a new challenge for me, which was staffing up to handle the complexity. We've added more than 600 people to the team, and things like clearance and brokerage operations, finance and duty billing, and customer service to help get goods cleared accurately, compliantly, and delivered on time, and to have the back end support in collecting those tariffs from customers where applicable.
Yeah, I actually had a package. My German mother sent me a birthday package that was rejected by customs and went back to Stuttgart. I still haven't gotten it. Are you having more and more of these problems where, because of new customs rules, because of new tariffs, because of the complexity, a lot of shipments just can't get through?
I wouldn't say we've had a lot of problems with goods not getting through. I think there are two things. One up front, really important as a consumer, to, when you're buying something online or you're having a family member ship it to you, make sure the paperwork is accurate, contains all of the harmonized tax code information, that we've got a good email address or cell phone number that we can reach you when we need to ask a question for some clarity, or we need to collect those duties and taxes. I think if we get those things right, me adding the team, the staff that can actually do the clearance work and connect with you can mean that there's no disruption at all. Overall, volumes are good. The clearance times are normal, and we're getting them delivered. I'm sorry that you had that issue with the package coming in from Stuttgart.
Wait, yeah, German customs are just the worst. Hey, I wonder if you have to add just people, or if you can also add AI to help with this kind of work. How much more is DHL using artificial intelligence?
Well, I think that's probably a little bit more into the future. For these immediate changes, because they happen so quickly, we've employed people and done the upgrades on our existing systems to make sure that we were compliant and connecting with CBP, and that we had the people to physically do the entries here in the US. I do think as we look to the future, we want to see if AI can get even better information on customs paperwork that we're collecting and bringing in. But I think that's a little bit more into the future. Maybe this time next year, I'll have a bigger update on the AI front.
Are robots part of the future as well for DHL, Greg, or do you already have a lot of automated work in your warehouses and your shipping points?
I would say we're still heavily reliant on people and labor to move the packages, to deliver the packages. We opened a facility that's probably our most automated outside of Chicago this year. It does a little bit more automation around our small letter sort. But this is still, logistics is still a lot about people moving packages and delivering them. Leveraging technology behind the scenes in customer service, maybe in the future in clearance, to help things go smoother for our customers.
What about the last mile? I've noticed more and more electrified vehicles, trucks, dropping packages. How deep is DHL into that technology?
Still a very important part of our strategy. We've got a pretty aggressive zero emission target by 2050 with some solid science-based interim targets for 2030. So most of my fleet purchase year in and year out is replacing traditional vehicles with electrified vehicles. It's still a challenge to make sure we've got a 250-mile vehicle with a good battery life and a good payload. And the infrastructure is still catching up across the U.S. We've had some success. The building I'm in here in Miami Gardens is almost all electric vehicles, so pretty proud of that.
So, Greg, what about the rates picture right now? I mean, things are looking better than you may have thought at the beginning of the year, or certainly the beginning of April. There's competition, of course, abounding, but you have individual idiosyncratic issues for some, the MD-11 groundings, for example. What do rates look like right now?
I would say from an overall standpoint in terms of rates, we've got a pretty stable environment after a few years coming out of COVID where we saw some pretty aggressive growth in cost of living or inflation. I think we're pretty normal now. I think the cost that most people are feeling is more associated with the tariffs, those additional costs, and they're trying to figure out how they weave that into their supply chain. That's not a cost really from DHL, it's from the government's assessment, but people need to figure that out in terms of where are they ordering from, and they're starting to look for alternatives. As you know, the heaviest burden tariff country is China, still a major source of manufacturing for U.S. companies, so they're starting to diversify. We see solid growth in markets like India, Vietnam, and Malaysia as people look for different ways to reduce unit cost in this new environment.
But if we look at, shipping rates for 25 and expected for 2026, what kind of increases are we going to see for those 2 years?
Well, we've called out our GPI at 5.9%. That's a fairly normal amount for us that reflects kind of some of the changes in dynamics, some of the changes in capacity, and some of the additional costs. I spoke to the more than 600 people I've had to add in order to manage clearance. So I think it's a normalized year overall.
All right, great to get some time with you, Greg. Thanks so much for joining us on this busy day. Greg Hewitt there of DHL Express talking about the shipping business, adding more than 600 people to deal with customs and tariff clearance. Let's get a check on what's going on in these markets. You can see that we still have red arrows. The S&P 500 about an hour and a half into the session, down 0.5% right now. The NASDAQ 100 down a little bit more. And the turnaround that we've seen for Nvidia shares not helping drive a turnaround for the broader market. Nvidia shares currently up 1.33%. Coming up, the race for New York's next casinos is tightening as Steve Cohen scores approval for an $8 billion project at Citi Field, trying to beef up that baseball empire with gambling, soccer, and more. We'll have the latest next. This is Bloomberg. No casinos yet. All right, Mets owner Steve Cohen just cleared a massive hurdle in New York's casino sweepstakes, winning approval to build an $8 billion complex for gambling right next to Citi Field. Bloomberg's Greater New York reporter Naha Katan joins us now with more details on, this is amazing in terms of the empire building story that Steve Cohen has out in Queens. He's got the Mets, right? Citi Field, obviously. He's got a soccer stadium now, and he's going to build a big gambling complex out there, right?
That's right. And, the job creation is incredible. 17,000 construction jobs, 6,000 permanent jobs, and it's going to make, tons of money when it opens, slated for 2030, $3.9 billion in tax revenue, generating $850 million in taxes.
So that all sounds great. Of course, there will be victims because it's gambling, but I guess they would be doing it somewhere else if they weren't doing it here. Do people think it's better that we have it, legal gambling in a casino rather than, I guess, in the basement of some shop downtown?
Well, Steve Cohen faced some opposition from a local council member who tried to prevent it, but in the end, the community came together, the borough president, and people really wanted this casino.
Isn't the idea, I have a guy on the inside, Joe, who knows everything about sports adjacent stories, and he says Steve Cohen has cleaned up the whole area around Citi Field. Like, there were a lot of chop shops there. It was really a dirtier or maybe a trashier neighborhood that he has now kind of leveled and is going to, I guess, gentrify, right? Isn't that good for Queens?
This is what the people are saying, right? Through their local politicians. He also wants to have a ferry come to Citi Field. This is something still in the works. We wrote that story a few months ago, but that could happen as well, so that people can come straight to Citi Field to gamble on the ferry.
So I guess I was going to ask what's next. And I guess the ferry is part of that answer, right? Traveling to and from this huge complex is currently a little bit difficult, and that would make it a lot easier.
Yes, definitely.
So what has to happen now? Because I'm imagining there will still be a lot of pushback against building this giant casino.
So actually, this is just the board recommending that they get one of 3 sites. All 3 were actually picked. So Genting has theirs and Bally's has theirs. All 3 of them will now have to just get a gaming commission license approved by December 31st. There's not going to be any problem with that. And I don't think there's going to be as much pushback as we might have thought. There were some protests, actually, just 10 people who got up and were upset about the decision. But apart from some Bally's pushback, perhaps, we're not seeing, a major force coming out against these casinos.
All right, well, it's a fascinating story, and I look forward to your reporting, Naha. Thanks so much for joining us. Naha Katan covers Greater New York for us. This is Bloomberg Open Interest. Let's take a look at what's going on right now in terms of the stock market. An hour and a half into the session, we do see the S&P 500 clawing back some of the losses here, now down just 0.3%. The NASDAQ also now down just 0.3%. And I told you just before the break that Nvidia had turned around and started showing some serious or substantial gains. We do see Nvidia close to 1.5% to the upside. It's interesting to see Google to the downside. And when I showed the breakdown on the move screen, you saw that it was almost all the AI play that was down. We had Broadcom as a loser. We had Google as a loser. We had Meta as a loser. But right now, Nvidia helping to keep this market from deeper losses. Disney doing well, up 1.25%. I've heard now a couple of good reviews for Zootopia 2, and Disney has a whole slew of sequels coming out. I did actually go see Zootopia 2. I didn't think it was that good compared to the original, but my daughter liked it. Warner Brothers right now not moving a lot, but awaiting final bids that they had asked for. Gold down, but at $4,230 now. It's come so far, so fast that Barrick is considering IPOing its North American assets. So Barrick rising about 3% on that news. Coming up tomorrow, Morgan Stanley's Mike Wilson shares his outlook for stocks. Plus, Nancy Tangler joins us, as well as Meredith Whitney on this program. We hope you join us for it as well. This is Bloomberg Open Interest.